Imagine you invested in the Ghana Stock Exchange at the beginning of this year. Today, you could be looking at gains that would make your savings account look very small. The Ghana Stock Exchange Composite Index has gained roughly 74% this year. But here is the question that matters if you haven't invested yet. Are you too late? Because when an investment has already gone up this much, there are two completely different possibilities. You could be arriving late to a party that is almost over, or you could be arriving just as Ghana's stock market is entering a much bigger wealth building cycle. So, should you invest now? Should you wait for a correction? Or are there still Ghanaian companies that could potentially deliver attractive returns from here? That's exactly what we are breaking down today.
Unlocking Africa's Wealth Code, Money Code Africa.
Welcome to Money Code Africa. On this channel, we break down money, investment, business and wealth building opportunities in Africa in simple language. And today's video is particularly important because we are not going to look at the 74% gain and simply say stocks are going up, so buy. Instead, we are going to ask the more important question: what is actually driving this rally, and what should an investor do after such a massive increase? Make we go inside. One may wonder, what does the 74% increase actually mean? First, let's put that 74% number into perspective. The Ghana Stock Exchange Composite Index tracks the performance of companies listed on the Ghana Stock Exchange. When the index rises by around 74%, it doesn't mean that every single stock on the Ghana Stock Exchange has increased by 74%. Some companies may have risen much more, others may have risen less, and some may even have fallen. This distinction is extremely important because if you hear the Ghana Stock Exchange is up by 74%, you shouldn't automatically conclude every Ghanaian stock is now expensive. The market is made up of different companies, different industries, and different valuations. And that's where the real investment question begins. Instead of asking, has the market already gone up? We should ask, are the companies I'm interested in still worth their current prices? That's a completely different question. Now, I'm going to get into why the Ghana Stock Exchange stocks have been rising. So why has the market performed so strongly, you may ask? There isn't one single reason. One major factor is improved investor confidence. When investors become more confident about Ghana's economic outlook, they may become more willing to put money into Ghanaian companies. Another factor is corporate profitability. Remember, when you buy a share, you are buying a small ownership interest in a company. If that company is growing its revenue, controlling costs, increasing profits, and paying dividends, investors may become more willing to pay more for that company. Then, there is the banking sector. Financial stocks have been an important part of the Ghanaian market rally. Banks can benefit when economic conditions improve, credit conditions become healthier, and profitability strengthens. And then we have dividends. For many Ghanaian investors, the stock market isn't only about capital appreciation. They also want companies that can potentially pay them cash dividends. So, there are really two ways investors can potentially benefit. The share price increases and the company pays dividends. But here is where we need to be careful. A rising market doesn't automatically mean every company deserves a higher price. And this is where many inexperienced investors make their biggest mistake. Imagine you see a stock that has risen from 5 cedis to 10 Ghana cedis. You might think, this stock has doubled. I missed it. But that's not necessarily true. The real question is, why did it double? Did the company's profit double? Did its revenue grow? Did its dividend increase? Did the company's future prospects improve? Or did investors simply become excited and push the prices higher? Because there is a huge difference between a company becoming more valuable and investors becoming more willing to pay more for the same company. If the share price rises much faster than the company's underlying business performance, valuation can become stretched. And eventually, the market may correct that difference. That's why you should never invest simply because this stock is going up. By the time everybody is talking about it, a lot of the easy money may already have been made. So you may wonder, are we too late? Or are you too late to buy some of these stocks? Now let's answer this big question. Are we too late? My answer is, not necessarily. But I also wouldn't say just buy anything because the market is rising. Here is why. The stock market doesn't move in a straight line. Even after a major rally, individual companies can continue growing for years if their underlying business continue to grow. Think about it this way. Suppose a company is earning 100 million today. 5 years from now, perhaps its earnings 200 million. If the company continues growing profits expanding its business and generating cash, its value could potentially increase as well. So the fact that the stock has already risen doesn't automatically mean the opportunity is finished. But, and this is a big but, the price you pay matters. A fantastic company can become a terrible investment if you pay an unreasonable price for it. And an ordinary company can sometimes become an attractive investment if its price is low enough relative to its fundamentals. That's why the next stage of this market is likely to be less about simply owning the market and more about selecting quality companies at sensible valuation. But if you're a beginner, don't make this complicated. Before buying a stock on the Ghana Stock Exchange, start with these 5 questions. Number 1, is the company profitable? Look at the company's financial statements. Are profits growing? Are profits stable? Or is the company constantly struggling? A rising share price doesn't fix a weak business. Number 2, how much debt does the company have? Debt isn't automatically bad. Companies can use debt to expand, but excessive debt can become dangerous, especially when interest costs rise or the company's cash flow weakens. You want to understand whether the company can comfortably manage its obligations. Number 3, does the company generate cash? Accounting profits and actual cash generation aren't always the same thing. A company can report accounting profit while struggling to generate cash. Cash is what ultimately allows businesses to invest, pay debt, and potentially distribute dividends. Number 4, what is the valuation? This is one of the most important questions. Don't just ask, is this a good company? Ask, am I paying a reasonable price for this company? Metrics such as price to earning ratio, dividend yield, and other valuation measures can help investors assess whether a stock appears expensive or reasonable valued compared with its earnings and peers. Number 5, what is the company's future? This is the question many investors ignore. You aren't buying yesterday's profit. You are buying a claim on the company's future. So ask, what could make this business bigger in 5 years? Is the company expanding? Is demand for this product increasing? Can it increase profits? Does it have a competitive advantage? If you can't explain why the company could become more valuable in the future, you probably shouldn't rush into buying it. Number 6, should you wait for a market crash? Now, some people will say, I will just wait for the market to crash. Sounds too much, right? Not necessarily. The problem is that nobody knows exactly when the correction will come. The market could fall 10%, it could fall 20%, or it could continue rising while you are sitting in cash waiting for the perfect entry. This is why trying to perfectly time the market is extremely difficult. Instead, many long-term investors focus on gradually building positions. For example, rather than putting all your available money into the market on one day, you could develop a disciplined investment plan and invest gradually according to your personal financial situation. That can reduce the pressure of trying to predict the perfect entry point. But remember, investing gradually does not eliminate risk. Stocks can still fall or rise. Now, let's make this practical. What if you are watching this and saying, I don't have 50,000 Ghana cedis to invest? That's okay. You don't necessarily need a huge amount to start learning about investing. Suppose you have 1,000 Ghana cedis. Your first goal shouldn't necessarily be, how can I turn this into 10,000 Ghana cedis quickly? Your first goal should be, how can I build a disciplined investment habit? You could research companies, understand their financial statements, monitor their results, and gradually build your knowledge. Because the biggest advantage a young investor has isn't necessarily money, it's time. If you learn how to invest properly and consistently, over many years, compounding can become much more powerful than trying to make a quick profit. If I were approaching a market that had already risen this strongly, there are 3 things I would avoid. Number 1, what we call FOMO. Don't buy a stock simply because everyone is talking about it. Number 2, borrowing to invest. Don't take expensive loans simply because you think the market will continue rising. If it falls, you will regret them. The market doesn't owe you profits. Number 3, putting everything into one stock. Even if you're extremely confident about a company, concentration creates additional risk. Diversification doesn't guarantee profit, but it can help reduce the damage caused by one investment performing badly. And most importantly, never invest money you cannot afford to leave invested for the long term. Here is what I think is actually exciting about Ghana's stock market. The biggest opportunity may not simply be the market is up 74%. The bigger opportunity is that more Ghanaians are beginning to pay attention to investing. For years, many people focus almost entirely on savings accounts, treasury bills, property businesses, and other traditional ways of building wealth. But ownership of productive business through the stock market can also become part of a long-term wealth building strategy. The challenge is learning to separate a good company from a good investment at today's price. Those are not always the same thing. So, are we too late? I don't think the answer is simply yes or no. If you are expecting to buy any random Ghanaian stock today and make another 74% quickly, that's dangerous thinking. But if you are looking at the market with a 5-year, 10-year or 15-year mindset, the fact that the market has already risen doesn't automatically mean there are no opportunities left. The strategy now should be different. Don't chase the rally. Study the businesses, understand their financials, look at their valuations, understand the risk, and invest according to your own financial goals and risk tolerance. Because the goal isn't to catch every rally. The goal is to build wealth sustainably. Now, I want to hear from you. The Ghana Stock Exchange is up around 74% this year. Do you think the rally still has room to run, or do you think a major correction is coming? Drop your answers in the comments. Buy if you think there are still opportunities. Wait if you think the market has run too far. And if you want me to break down 5 Ghanaian stocks investors should be watching right now, including their fundamentals, valuations, and dividend potential, hit the subscribe button and turn on your notifications. This is Money Code Africa, unlocking Africans' wealth code. Don't just earn money, learn how money works. Thank you for watching, and like always, I'll see you in the next one.